It's that time of the year again where we provide our Australian property market predictions for 2025. Now, we did the same exercise last year and correctly predicted the top performing cities will be Perth, Adelaide, and Queensland. More importantly, we identified the top locations within these cities for our clients. As a result, our clients secured top growth assets in these locations with an average growth rate of 18% in 2024. We also correctly predicted certain western suburbs in Sydney will also be the top performers in New South Wales. Properties we secured here for clients have risen by 23%. In addition to this, we have called that peak interest rates were in despite a massive fear of additional rate rises mid-2024. While we got a lot of predictions right, we were incorrect to call a decline in the premium Sydney unaffordable markets. These suburbs still rose slightly in 2024, but are now starting to decline. Moving forward, we will be even more detailed with our price predictions, basing this off the SQM research model. Leveraging this process, we will outline a base case scenario and our price predictions, along with other scenarios we believe are less likely and how all these outcomes will affect property prices. So, looking into 2025, we are seeing a more fragmented property market. Our base case is we will see rate cuts starting from Q1 next year, which will revive a market that is slowing down in unaffordable cities. We will also see continued immigration growth of at least 450,000 people, which is close to double our historical averages. These rate cuts we forecast will result in a surge of consumer confidence, borrowing power, and inject strong buyer demand into a market with historically low supply. With this base case, we continue to see Perth, Adelaide, and Queensland performing the best. For select client strategies, we are still extremely focused on certain locations in Perth and Adelaide that will drive the majority of our forecasted growth. However, we have primarily pulled back and stopped looking at the Brisbane market for clients, given some of the affordability metrics we're seeing. Now, select locations in regional Queensland are much more appealing from an affordability and growth perspective. We must disclose that we were purchasing properties under $350,000 and even under $300,000 in regional Queensland before, and are not targeting some of these same pockets anymore, given we have seen up to 50% growth in these pockets and properties are starting to hit their affordability caps. Our clients benefit from us managing their portfolios to provide these guidelines on when their properties may have peaked or when they will peak, and this allows us to maximize their growth by moving to different markets and capitalizing on the market cycles. Many pockets in northern and regional Queensland are now seen as extremely risky investments from our perspective, given the affordability caps are fast approaching these locations. Melbourne, on the other hand, will likely provide the most long-term upside across select locations at the current price points, given this market has been declining the last few years and has showed multiple signs that the bottom is in. Now, this does not mean properties in Victoria will begin to boom tomorrow. However, we have shortlisted a handful of locations that have already started to grow from July this year, and we are securing properties here up to $90,000 under bankable market values. Since we called a bottom in the Victoria market in July, we have been focused on securing properties for long-term client strategies or for buyers who cannot afford a 12 to 20% deposit today. We have locked in deals with just a 5% upfront deposit, with positive cash flow for clients and flexible settlement dates to time this next boom cycle in Victoria. This has allowed our clients who couldn't invest in a property today to secure a top growth asset at the bottom of the market. We see unaffordable properties ranging from $2 to $5 million continue to carry the most risk, as these buyers are reliant on bank lending and their incomes. If there was more economic softness or rates remaining high for longer or even a global recession, we would see these blue chip areas decline significantly. Overall, while our base case has all capital cities apart from Canberra seeing price growth in 2025, we only see select locations driving this performance. This is why 70% of property investors still lose money. If you want the best chance to outperform this market and leverage a data-driven investing strategy to understand what's the right way for you to approach your property journey, book in a free consultation right now. Feel free to review our 2025 predictions table across all our social platforms so you can see a breakdown of how we see each city performing based on the most likely scenarios.